Hello, Prithvi here from Vinka Wealth. In this video, I want to talk about why long-term investing makes sense in equity markets. It is better to be invested for long-term if you are entering into equity markets. We'll see these topics today. The first one is common mistakes and myths when you are doing long-term investing. And the second one, historical returns to prove why long-term investing makes sense. And the third one, last 20 years what happened to Indian markets. I will show the graph how it has increased from last 20 years. And the fourth one, what are the equity returns and how it is compared to asset classes, other asset classes like real estate, gold, fixed deposit. I will show you what is the comparison between equity and those asset classes. Common mistakes and myths. So there are two extremes of investing. One can be very aggressive investor or one can be very conservative investor. Aggressive investor is someone who want to take more risk and want to make more profit. Conservative investor is on the other hand who don't want to take risk at all. In fact, he want to save in fixed deposits or in a locker. So we'll talk about aggressive investor first. These investors, what they sometimes do, they set unrealistic return target. For example, 1% a day. I want a 1% a day, or that will be 30% a month, and that is 360% a year. No instrument gives that. If you are investing in a long term into the equity markets, you will get 12 to 15% as a return, and that is what you need to expect. And in this throughout video, I want to highlight that message that you will get 12 to 15% return if you stay invested in equity markets. And the second one, they always think about only profit when you take risk. No, if you are taking risk, you may get negative return in the shorter periods, but in the longer periods you will make money. But you need to be ready to see that negative number on your portfolio if it is a shorter period. Selecting few stocks and believing they will generate the wealth in long term is also a problem, because you need to actively monitor the stocks time to time and then you need to stay invested. Or buy a mutual fund which will serve the purpose. On the other hand, if it is a conservative investor, they think that markets are too risky. Investing in markets is not risky. Trading into the markets is risky. So in the long term, markets are not risky. Waiting for a fall before investing is also a problem. Why? Because if markets move up, you will lose all that up move and you will lose the return. Super conservative for long term investments is also a problem. Why? Because for short term periods you should not take risk. For long term periods you should take risk. Why? Because if it is a short term period, you need that money in 6 months or 1 year. That's why you should not take risk. But if it is a long term period, risk reduces with time. That's why you need to take risk in the long term periods. Less patience is possessed by investors generally. Why? Because when markets fall, they don't want to invest anymore. They want to stop SIPs. They want to pull out the money. But this has to happen reverse, right? When markets fall, you need to buy more. Then only you will get units for cheaper. Now we will see what are the historical returns. If you have invested only for 1 year time period, you will get the return anywhere in this range. That means if you have invested only for 2001 to 2002, or if you have invested only for 2002 to 2003, 2003 to 2004, like that, you will get the maximum return of 107% or minimum return of minus 55%. You may get negative return in the first year if you have invested. And you look at the standard deviation, it is 27. That means 27% it is deviating. The fluctuation you get. But if you stay invested for 5 years, there is no negative return. You get return anywhere in this range only. That means the maximum return is 47%, minimum is minus 1%. If you have stayed invested for 10 years, for example 2000 to 2010, 2001 to 2011, like that, so these are the returns you will get. The minimum return you get is 5%, maximum return is 22%. In this range only you will get. Look at the standard deviation, it is only 4, which is less fluctuating, right? This is the key slide. If you have stayed invested for 15 years, the minimum return what you get is twice of fixed deposit what these guys are offering today. The maximum return you get is 19.3%, minimum is 10.6%. Look at the standard deviation, it is only 2%. That means there are very less fluctuations. You get a standard 12 to 15% on an average you will get if you stay invested for 15-year period. I have kept this in a table for better comparison. If you have invested only for 1 year, the return can range from minus 50 to 100. But if you stay invested for longer periods, for sure you will get 12 to 15% in the longer periods. We'll see what last 20 years what happened to Indian markets. This is Indian markets chart from last 20 years. It is a Nifty 50 chart. If you can see, markets are at 1600 when it is 2000. Now markets are at 18,000 to 16,000 it is fluctuating, which means that you get 12% return as a CAGR, compounded annual growth rate, which means every year it gets compounded. If it gets compounded, how much is the percentage? We calculated that. In between, you may get crash. For example, if it is 2008, you got a crash of minus 50%, but then it got recovered. Markets recovered in a 1 year time frame. And then, for example, if it is a corona minus 30% down, then market recovered in 6 months itself. And now there is a Russia war, then markets will recover again. So if it is a short term periods, you get a negative, but in the long run you get definitely 12 to 15% as a return. We'll see the return comparison of equity versus other asset classes. As we discussed, equity markets will give 12 to 15%. On an average, real estate will give 8 to 11%. Gold will give 8 to 9%. Fixed deposit, PPF, Sukanya Samriddhi will give 6 to 8%. Which means that if you have invested 1 lakh 20 years ago, in equity markets you get 11.2 lakhs. In real estate you get 6.7 lakhs. In gold 5 lakhs. And fixed deposits of PPF, Sukanya Samriddhi, you get 4 lakhs. What I want to tell from this is that if you want to stay invested for longer periods, equity is the best asset class to be invested and see your money growing. And if you have a short term period, if you want to save for the short term, you need to invest in fixed deposits to keep that money safer. So it will be like this. If you have 100 rupee, it's better to put 40 rupees into equity markets, 30 rupees into real estate, 5 rupee into gold, and remaining into fixed deposit. I hope this message is useful. If you have a query, please write to support@vincawealth.com or WhatsApp us to the number given below. Thank you.